Hello and welcome to this special edition of Market Masters. I'm Prashant and with me is my colleague Surabhi Upadhyay. Axis Capital is holding its India flagship conference this week with the theme India as an Asset Class. The conference will see 132 corporates participating. It has also seen 625 client registrations so far. So a lot to look forward to from the conference itself. Now, as far as markets go, after a few years of absolutely stunning superlative performance, the market is cooling off just a little bit. Are we at a bit of a crossroads? How important is this going to be from here? Which way do we go? Which means a lot of questions ahead. We have with us the top team at Axis joining us. Amitabh Chaudhry is MD and CEO at Axis Bank. Neelkanth Mishra is Chief Economist, Axis Bank, and Head of Global Research at Axis Capital. We have veteran investment banker Atul Mehra, who is the MD and CEO at Axis Capital, joining us as well. Gentlemen, great to have all of you here. Thank you very much for your time here on CNBC TV 18. First up, let me sort of wish a fantastic conference ahead. And I'm going to get to maybe a mood check a little later if you've had the opportunity to sense the pulse there. We'll do that. Amitabh, we are speaking after a while, and I think it's so important to get a sense from you first up. And I think viewers and everyone watching will want to get that from you. You have a bird's eye view about, what's the state of growth in the economy, in the real economy, Amitabh, because we've had a bit of a cyclical, seasonal, whatever you want to call it, slowdown for the last few quarters now. The budget came in with some measures, tax cuts. The RBI on Friday has stepped in with a 25 basis point rate cut. How should we sort of see the trajectory of growth from here in the real economy? Amitabh, go on.
Well, I think the sentiment in our minds does remain a bit cautious at this point in time. We are seeing on one side government spending definitely picking up, but on the private side actually things have really not moved as much as we expected. Obviously the government has taken measures by infusing almost 1 lakh crores in the next 12 months or so in terms of some tax cuts. RBI has taken a step forward in terms of cutting the interest rates, but it has to ultimately reflect in the economy in real terms. I think we are watching the indicators quite closely. I think the power demand remains down. Cement is really not picking up as much as we want. So we need to be watching these indicators, and our view is that as these things roll forward, maybe the high frequency indicators will see a positive movement in May or June. So it remains cautious. Our view is that we have to keep watching the risks quite closely. The credit growth and deposit growth remains muted. RBI has assured during its monetary policy announcement that they will provide durable liquidity, and they do realize that the credit growth does need to pick up for the GDP growth rate to come back to the 6.5–7% range, and that's an important element of that. So hopefully as RBI takes these measures in the next couple of quarters, we'll see a positive movement. But right now, I mean, while we are optimistic about what could happen, we remain cautious because the real scene on the ground is we are not seeing enough movement at this point in time.
And that is very well put. You mentioned May or June. How would you describe this slowdown, Amitabh, as you see it? You'd be seeing in so many segments across the bank, right? Is this a bit of a temporary thing? Is this maybe a little entrenched? Which areas, if you can? And maybe, I mean, how many quarters out before we are on the mend, in your opinion?
No, well, I said, a lot of it is in the hands of the government and RBI. They have, RBI has taken some proactive steps to ensure that the lending in some sectors is reduced or contained. And it has led to, obviously, a clear deceleration in credit growth. RBI is also on the deposit growth side. Enough has been talked about as to why deposit growth has been muted, and the combination of these two factors is obviously causing, from as far as the banking sector is concerned, a slowdown in overall growth. And because the growth is overall slowed down, obviously it has its own impact on the economy. On the other side, while the government spending was not there in the first half, we're expecting it to pick up the second half, so that's a positive sign. But the private capex is not picked up, and Neelkanth is here. I'm sure he can give you more insights. But overall, I think the good news is that the government recognizes something needs to be done, RBI recognizes something needs to be done, some steps are being taken, more steps are being promised, and hopefully, I mean, given where the Indian economy is, where it is placed, again, the overall global macroeconomic situation, even though there's a lot of uncertainty there, I think things definitely should move up where we can get back to our, the expected growth rate of 6.5 to 7%. Now, obviously, this is under this cloud or call it umbrella of a huge amount of macro, global macro uncertainty. But I think we've got our act right as a country. Hopefully, in spite of that uncertainty, we can get back to the 6.5 to 7% growth rate in the next couple of quarters.
Amitabh, on margins, just a quick bit, the higher yielding segments have seen a bit of a slowdown, unsecured, etc. At the same time, you got a repo cut. Will margins sort of be a little lower, and how much? Not just, maybe for you if you can, and for the industry?
Well, again, it depends on a number of factors, but yes, immediately there will be a clear passing of this benefit to a large part of people who have taken loans from us. So it will have an impact on margins, a negative impact on margins. The deposit rates, I don't think it will come down in a hurry. It will take some time for it to percolate through the system. Also, the repricing of deposits will take some time. So on one side, while you might see an immediate cut on the yields which you're getting on some of your assets, you might not get the decrease in cost of funds. It will take, I would say, somewhere between 2 to 4 quarters for it to happen. So margins will be under pressure. Now, this is assuming nothing else happens. But on the other side, if there is a little bit of easing of liquidity, you see that economic growth is coming back, and so on and so forth. There are other levers which are available to you which can allow you to compensate for this immediate decrease in margin. So let's see how this pans out. But immediate impact is obviously there will be a decrease in net interest margin, nothing else changes.
Mr. Chaudhry, hi, morning, and morning to the other two gentlemen as well, Neelkanth as well as Atul. Just to complete this point on margins, like you said, this will depend on a lot of different varying factors, but given where we are right now, unless and until something new happens in liquidity, would this compression be, could it be system-wide, 50 basis points, 100 basis points, more, less, what's the best assessment at this point?
It will not be nowhere close to the 50 basis points you're saying. It will be much, much lesser. Okay. Because end of the day, please realize that it's a 25 basis point cut. This does not immediately impact every asset class. All the loans are not linked to MCLR. So firstly, it impacts a certain amount, a certain percentage of your assets. Then it's a 25 basis point cut. Obviously, we will not sit here. There will be something on the margin which we'll do. So I don't think the impact will be anywhere close to 50 basis points. It will be much lesser. It will be too early for me to speculate and start giving some guidance on this. I think once we have a better idea, we will. But I can definitely assure you it's not a 50 basis point.
Okay. That's very, very reassuring. Thank you for that clarification, that it'll be much lesser than 50 basis points. And, we do want to come back to the whole unsecured piece as well. And in terms of regulation, what has been pushed forward, which is ECL, etc., and what hasn't. But we'll come back in just a minute. Let me quickly go across to Neelkanth as well. We had an exhaustive conversation with Neelkanth just after the budget on CapEx. And Neelkanth's point was that you need to take a far more nuanced view. It's not like there's a lid on CapEx. But Neelkanth, we're also dealing with very fast-changing global news headlines on tariffs. And the China retaliatory tariffs are a reality. We are hearing that, this week we'll see more action. So in that sense, how is India placed? We're also looking at this high-profile meeting between Prime Minister Modi and Donald Trump as well. So what should we start penciling in terms of any potential tariff impact for the Indian economy and therefore the market sentiment?
See, I have held the view for a while that while there is a lot of global turbulence, the levers for growth are completely internal. So there will be some impact, as we have estimated, if there are reciprocal tariffs, and this was done before the headline rates were cut in the budget. If US was to impose the same rates as India imposes on US imports, you would see an impact of about $7 to $8 billion. But I think that number is going to be a lot lower because India, as you must have seen in the budget, has actually cut those numbers. There is, I think, significant global uncertainty. I think there is, the more the uncertainty on investment. And therefore, it makes sense to be a bit cautious on external demand. But frankly, if we can get liquidity into the system, if we can get credit growth to start moving up, we will start to see, I think, the domestic economy reviving. The importance of the real estate cycle, importance of the power generation capex. You must have seen over the weekend also a very major steel company announced a 1 lakh crore investment. So, as we have discussed often on our shows, that when the real estate cycle is on an upturn, the cement volume growth and the steel volume growth is 8 to 10%. when the real estate cycle is on a downturn, both these numbers are quite weak. So the economic cycle and reviving it through internal means, through provision of liquidity. In fact, the governor very interestingly also mentioned that safety and efficiency have to be balanced, that there is a cost to excessive regulation, and that they will be taking a step back from that as well. So if we are able to revive credit growth from 11 to 14, 15%, I think we should be able to see a significant rebound in economic growth.
Okay. Our drivers of growth are internal. Neelkanth, and this estimate was pre the duty cuts in the budget. You said $7 to $8 billion worth of impact. So
Yes.
that is what is that
if there
exactly?
were reciprocal tariffs. So if Trump says that,
no, $7 to $8 billion less of trade if that were to happen, less of exports if that were to happen. This is essentially what you're saying.
yes. So and that's the headline first cut impact. Of course, then there will be diversion. There could be price changes, and the impact would be net less. But if you just assume that the U.S. was to impose the same duties as India imposes on U.S. imports or imports from the U.S., then the headline, the first cut impact would be 7-8 billion. Of course, there will be manufacturers taking diversionary routes, routing to different markets, and the net impact could be even lower than that. But after the adjustments that were made to say, imports of high-end motorcycles and cars and the stuff that India imports from the U.S., the number could be even smaller than that.
Do you think tariffs we'll have to concede lower tariffs in response to the threat of reciprocal tariffs from here, even after what has been done in the budget?
See, remember that this is part of a negotiation. And every single leader, you must have seen the Japanese Prime Minister going to the US and sitting across and discussing things. So everything with the current US regime is going to be a negotiation. There will be economic and non-economic factors, both of which will start to matter.
Sure.
Will we have to bring down our tariffs even after the ones that we have changed? I think time will tell, but I suspect that it will be part of a broader negotiation and not just limited to the import tariffs on goods.
Absolutely. We have to take a quick commercial break here. Gentlemen, stay with us. We'll bring in Atul into the conversation as well and ask him what's causing FIIs to continue to sell. So that's coming up in just a bit. That conversation with the Top Access team continues. Stay with us.
Welcome back to the special conversation. We have the top team of Axis Bank with us just ahead of their investor conference. We've got a pulse of how the banking environment is looking with Amitabh Chaudhry. Neelkanth's given us a hint of what these tariff wars and tariff talks could mean for India. Atul, let's come to you now on the market sentiment. We all were thinking and keeping fingers crossed in December that this FPI selling would end. Guess what? I looked at the latest numbers this morning. 85,000 crores already gone so far in 25. And that's just the listed market selling. And then there are the insiders who've been selling for a long time, promoters, foreign promoters, private equity, etc. in the deal market. What's your sense on the mood on India?
So the mood on India continues to be still good, still quite robust, still quite favorable. Nothing wrong. India still continues to be amongst the best performing markets and the most attractive market globally. Yes, there are a couple of things which have set us back, and those I call as temporary dislocation, not as fracture. We need to get this in order, and I think there are a couple of things which are weighing on the back of the minds of the investor. And first and foremost is this whole rupee to dollar equation. Second foremost is what are the earnings growth going to look like, and that is the most crucial question in the mind of every investor, whether it's a domestic or the FPI or the private equity or even the man on the street. The earnings growth is the crucial question in their mind. The third important factor is the whole geopolitical situation and the new world order. What does it look like and where does India stack up? How do we come out of that? And last but not the least is the resilient in the economy and how are we growing. So these are some of the broader themes that needs to be addressed. I think we have answers to it. We have path which is very clearly visible, but I think we need to remove some of the haze out of it so that the runway is clearly visible for more inflight of capital to happen into India.
You know, Atul, I completely take that point, but the other piece, the selling from insiders, and we kept seeing that through much of 23, a lot of 24, right? The block deal buzz that was going on, where either early stage investors were selling or Indian promoters were selling, and a lot of companies came to IPO as well. In the midst of all this, some global MNCs came and decided to list over here. For instance, you know, we've got the Hyundai listing, LG is about to list. But there are others who are winding up. For instance, Whirlpool, AkzoNobel looking to sell a part of its business as well. So what's your sense on the big PE sort of mood? What does that tell us? And the MNC mood? I mean, what clues or cues can we pick up from these actions?
So let's divide this question into two parts. Have we seen the supply coming from what you call as insider? Yes, that will continue, and that will continue in a big way, even in 25-26 that we are currently on. Let me give you some data. In 23, we saw total activity of around 15 to 18 billion dollar. In 24, we saw around circa 40 billion dollar. In 25, we could see as high as 50 to 55 billion dollar of sale through various corners. So that's the supply that is going to hit the market. And to add to it, you're going to see some of the foreigners, like what you mentioned, Hyundai, LG. There will be what we call as a whole host of companies which are turning upside down, which were listed, which were incorporated abroad, are getting folded into Indian structure. You will see a lot of activity on that count. And the reason for that is very clearly, India is a great market. India is a very liquid market. India is a very robust market. And we have all categories of investors participating in it. So it's a market which is now a very matured market, and it is moving faster to being called as a developed market, no more a developing market.
But Atul...
we have a huge FII interest still present in India. We have domestic mutual funds, pension funds, insurance companies, family offices, high net worth individual, man on the street, retail investors.
Absolutely. I mean, the depth
all
of the
participating
market...
still in a very big way. So which is what makes India a great market. And there is enough liquidity
quick response.
for, I quote unquote, high quality companies at good valuation to get absorbed in Indian markets.
No, absolutely. 10-second response. Is there a risk of supply overwhelming the secondary market, supply overwhelming demand, like we saw in the late 90s? Too much supply.
It is to some extent. And we need not worry about it as long as we have the domestic flows. As long as we have the domestic flows which are robust. And there, the key indicator to watch out for is the SIP flows. I think as long as the SIP flows are adequate or in line with what we are seeing, we have no reason to be worried or concerned about.
Absolutely. Amitabh, you were one of the earliest, just to get back to the real economy banking, to kind of flag off this stress in the unsecured segment. I mean, we've seen the microfinance space go through a bit of a cycle. Opinions vary where we're at there. What is your own sense, Amitabh? You know, are we going to see a broader spike in retail NPAs across segments?
So, Prashant, let me just slip in one word here before I answer a question. I mean, we are having this conference, Access Capital Conference, huge number of investors. I think perfect time to have this conference. A lot of uncertainty, but some steps have been taken, some more steps to be taken. So, you know, Atul and Neelkanth and the entire team have put together a great conference. We're looking forward to it. So, that's my two-bit. So as far as unsecured is concerned, yes, the stress started there. We have seen it extend to MFI. Obviously, we also see some of the governments or some of the local people reacting in a particular way. We have seen a stability, at least as far as the banks are concerned. We are seeing the stress stabilizing. I'm not saying it's stabilized, I'm saying it's stabilizing. I think you're seeing some positive signs on the MFI side also. But, you know, as all of us have been pointing out, if the growth slows down, if rupee depreciates, and it has depreciated so rapidly, if global uncertainty remains, tomorrow exports could get impacted if, let's say, tariffs come in. We cannot say that, by the way, this will not extend to secure forms of business. We are in the risk-taking business. The credit costs are normalizing. We have seen some, you know, obviously stress in some of the sectors. We have to be watchful and cautious that this should not extend to other asset classes also. Now, On the same side, in the earlier part of the program, I said we are quite optimistic about, what could happen because government and RBI is taking steps. But we at the same time, in the same breath, have to be watchful because the worry is that if we don't contain some of these things, it could extend to other asset classes. So we are watchful. We see no signs as yet, but we are watching the space very, very closely.
Mr. Chaudhry, you said exactly the same thing to Shireen in that interview in Davos. I was listening to it. And you said that we need to watch very carefully if unsecured stress starts spilling over to other classes. Since then, we've had liquidity measures taken up by the central bank. We've had this 25 basis points rate cut. There was commentary that the RBI is going to step in with more liquidity measures if and when needed. What more would you want to see from the RBI? I don't think they're going to go easy on unsecured. I mean, at least the commentary in that press conference didn't give us a clue that they'll very quickly lower the risk weights for NBFC lending or lower some of the prudential norms for unsecured. What more would you want to see from the central bank?
No, I'm not suggesting that RBI goes slow on some of the measures they have taken. I'm just saying that some of the measures, and individually the measures, have been, in some cases, so tough and tight. The credit growth has dropped to a level where, obviously you are seeing some signs of stress develop, or it is having an impact on the GDP growth rate. I mean, as Neelkanth pointed out in his earlier comments, that if this same credit growth could go back to 14-15%, it will have a positive reinforcing message in the overall growth rate of the economy, and some of the stress in the system could also go away. I'm not for a minute doubting what RBI said. I'm just saying we need to wait for those measures to come out and play out, and then hopefully we'll see positive signs. I'm quite optimistic. But the measures RBI has taken on liquidity have been sufficient enough to take care of the deficit in terms of liquidity. They are not led to any surplus liquidity. Interest rate cut is not going to lead to higher credit growth, in my mind. Interest rate cut has been done to kind of spur the economy and bring private capex or some of the capex back. Let's see how much time it takes for that, that lift to happen. So I think some measures have been taken. I think some more have to be taken, and they have to be consistently demonstrated for people to get the confidence and for the growth to come back.
Amitabh, we're running out of time, and I hope you allow me to sort of take this one bank-specific question. So you've reported this extensively, and I think it's become clear now that the insurance regulator, IRDAI, wants life insurers to reduce their bank assurance exposure. You have a 20% stake in Max Life. How do you look at that investment? I mean, has anything changed? Does that come under a bit of a cloud in your mind, or you stay the track?
Well, we have absolutely no doubt about why we have invested, and our commitment to Max remains steadfast. We see that as a long-term investment. We really, really like the team which we have there and what they've achieved over a period of time. So from our perspective, nothing has really changed. As far as the noise around bank insurance is concerned, yes, a lot of articles have appeared. We have not heard anything specific from the regulator as yet. That does not mean it might not happen in the future. I think at least when we look at data, and if the worry is coming from mis-selling happening in bank insurance, frankly, our data shows that the mis-selling is the least in the bank insurance sector. But obviously, if there is a concern being expressed by the finance ministry and the regulator, as an industry, we need to work in terms of firstly convincing them that no, maybe things are not that as bad. And if there are some areas, some customers who do suffer, we have to take obviously measures to ensure that whatever is bothering the customers and the regulators is taken care of completely. I mean, obviously we have to react to some of the concerns being voiced quite openly and frequently, especially by media.
Absolutely. And I'm glad that you sort of answered that. Out of time, but I wish you all the best of luck to the three of you and your teams as you put together this fantastic lineup of speakers. And of course, I mean, big client registrations, as we earlier pointed out. And of course, a bunch of foreign investors, companies, etc., who are there at the conference as well. So that's the Axis India flagship conference. And Amitabh, Neelkanth and Atul, great to have all of you here on the program ahead of that with your perspectives. Appreciate it very much here on CNBC TV 18. With that, it's a wrap on this special edition of Market Masters. Thanks very much for watching. Trading Hour will come up next in just a quick bit.